The ticker is AVUV. It launched in 2019, charges 25 basis points a year. That's 0.25%. And since inception, it has returned roughly 15.78% annualized. The S&P 500 has averaged about 10.4% over the last 100 years. You do not need to be a math genius to notice the gap. And yet I have spoken to over a dozen people this year who have been paying a financial advisor for years, 1 full percent of their assets, every single year. And not a single one of them had ever heard that ticker mentioned. Not once. In a few minutes, I'm going to explain why. And the answer is not incompetence. It's a structural incentive problem that the SEC has formally warned about in writing. And once you see it clearly, you will never look at a financial advisor's portfolio recommendation the same way again. Here's the thing. The research behind this ETF did not appear in 2019. It goes back to 1992. Two professors at the University of Chicago, Eugene Fama and Kenneth French, published what became the most replicated finding in all of modern portfolio theory. Small cap stocks and value stocks earn a persistent premium over the broad market, not occasionally, persistently, over data stretching back to 1926, 2 to 4% annualized above the market. Fama won the Nobel Prize in Economics in 2013 for this work. The evidence has been sitting in the academic literature for over 30 years. But until 2019, you could not simply buy it. You needed a financial advisor as the gatekeeper. That detail is where this whole story begins. And it's where it gets strange. I want to give this video a frame because it makes everything easier to follow. Think of what a casino calls the house edge. The casino does not need to win every hand. It does not need to predict the cards. It builds a small, persistent mathematical advantage directly into the structure of the game. Over thousands of bets, that small edge compounds into an absolute certainty. The house doesn't gamble. It runs a probability engine. The reason most people lose to the market over the long run isn't that they're unintelligent. It's that they're sitting on the wrong side of the table from the house edge. Factor investing, specifically small cap value investing through AVUV, is the closest thing a retail investor has ever had to engineering a house edge into their own portfolio. And the people who understood this first made absolutely sure it stayed behind a velvet rope for 4 decades. We're going to talk about who those people were, what they built, what happened to the velvet rope, and exactly what you now have access to as a result. Let's start with the advisor problem, because this is where most people's money is already sitting. In a few minutes, I'm going to show you the specific mechanism AVUV uses to capture returns that most small cap ETFs miss. But first, here's why the advisory industry is structurally set up to keep you from ever finding this on your own. 92% of financial advisors charge using an assets under management model, according to a survey of 621 US-based advisors in a Kitz's report. The median blended rate on portfolios up to $1 million is 1% annually. That number feels harmless in isolation. 1%. It's less than a restaurant tip. But here's the math your advisor will not put on a whiteboard. Take $500,000 invested for 25 years at 7% annual returns without any advisory fee. That portfolio grows to approximately $2.71 million. Pay a 1% annual advisory fee on the same portfolio, and the number drops to approximately $2.15 million. The difference is $560,000. Not fees you pay directly, that number is larger. That's the combined cost of the fees taken and the compounding growth that never happened because the capital was gone. John Bogle called it the tyranny of compounding costs. The fee does not scale linearly. It compounds against you. The larger your portfolio grows, the larger the dollar fee each year. But the work the advisor does for that portfolio does not grow in proportion. They rebalance, they send quarterly statements, they take your call when the market drops 15% and talk you out of selling everything. On a $2 million portfolio, 1% is $20,000 a year for that service. Every year. Now ask yourself, what does an advisor have to gain by recommending AVUV? It charges 25 basis points annually. If your advisor puts you into AVUV and charges you 1% on top, they are providing a transparent layer above a transparent, self-explanatory, academically grounded fund. There's no complexity to explain. There's no sophistication to justify the fee. The product explains itself. And sophisticated, self-explanatory products are, in the language of financial advisory business models, a problem. This is not a conspiracy. It is a structure. There are 3 levels to it. Level 1 is product affiliation. Many advisors work for firms that are either affiliated with or receive compensation from specific fund families. The SEC's own guidance document on financial conflicts of interest states directly that advisors who receive compensation in connection with the investments they recommend have a financial incentive to make recommendations that result in the receipt of that compensation. A wirehouse advisor at a major bank has an approved product list. AVUV is not a firm product. It generates no revenue for the firm, so it does not appear in the sales deck. Level 2 is the suitability standard versus the fiduciary standard. Here is something that surprises almost everyone. Not every person who calls themselves a financial advisor in the United States is legally required to act in your best interest. Investment brokers operate under the suitability standard, which means the recommendation must be appropriate for your financial situation. Not the best available option, just appropriate, suitable. You think the problem is that advisors don't know about better products, but actually, the problem is that many of them are not legally obligated to recommend better products. The velvet rope has a legal foundation. Level 3 is behavioral. Even fiduciary advisors, the ones legally required to act in your best interests, face a human problem. If they recommend AVUV and it underperforms for 2 or 3 years, which it will at some point because nothing outperforms every year, their clients panic. Small cap value had a brutal decade from 2010 through 2020 when growth in tech dominated everything. An advisor who put clients into small cap value during that period watched them underperform the S&P 500 for 10 straight years. The clients called, the clients were unhappy, some clients left. Recommending something that is academically sound but periodically boring or painful is a professional risk. Recommending the S&P 500 is safe because if the S&P 500 falls, the whole market fell and the advisor is not blamed. If AVUV underperforms for a decade, the advisor is blamed personally. The incentive is to stay in the safe lane. By the way, hit subscribe if you like the content, otherwise YouTube's algorithm may never show you my videos again. The result of all 3 levels is that a fund built on Nobel Prize winning research, charging 25 basis points, with roughly $26 billion in assets and a since inception annualized return of approximately 15.78%, does not show up in most advisory conversations. And the people who built the intellectual foundation for all of it spent decades making sure it could only be accessed through advisors anyway. This is where the subplot gets interesting. Stay with me, because this next part changes how you think about the entire history of what you've been told is mainstream investing. In 1981, a small company called Dimensional Fund Advisors, DFA, was founded on one idea. Eugene Fama's research on size and value premiums was real, and it could be harvested systematically through carefully constructed portfolios. The founders built funds specifically designed to tilt towards small cap and value stocks in a disciplined, low turnover, academically rigorous way. The performance was compelling. The approach was legitimate, and DFA made a deliberate choice that shaped the industry for 40 years. You could only access DFA funds through an approved financial advisor. There was no retail access, no brokerage purchase, no buying DFA on Fidelity or Schwab. You had to hire a qualified advisor, pay their fee, and only then could you get the benefit of what DFA had built. The stated reason was that DFA wanted advisors to coach clients through the inevitable periods of underperformance to prevent them from abandoning the strategy during the bad years. There is some genuine logic in that argument, but the structural effect was that the best implementation of the world's most academically robust return premiums was gated behind a fee. For 40 years, the house edge was behind the velvet rope. Then in 2019, Eduardo Repetto, the former co-chief executive and co-chief investment officer of DFA, walked out the door. He brought a team of former DFA portfolio managers, traders, and analysts with him and joined American Century to found Avantis Investors. He built the same machine. He charged 25 basis points, and he put it on the open market as an ETF available through any brokerage for anyone with no minimum investment and no required advisor relationship. AVUV was the first fund they launched, September 2019. Morningstar analyst Ryan Jackson told ETF.com that Avantis is cut from a similar cloth as Dimensional. Not only did its founder start there, but the lineup of products is quite similar, systematic, broadly diversified strategies that tend to lean towards smaller, cheaper, and higher quality companies. Within 5 years of launching, with nothing, Avantis grew to over $100 billion in total assets under management. AVUV alone crossed $26 billion, not because of marketing, because of performance. Let me be precise about what AVUV actually does, because the mechanism matters. The fund invests in a diversified portfolio of approximately 800 US small cap companies that combine two things simultaneously: low valuations and high profitability. Those two characteristics together are what Fama and French's expanded five-factor model identified as the cleanest driver of excess returns. Not cheap stocks alone. Plenty of cheap stocks are cheap because the business is declining. Not profitable stocks alone. Plenty of high-growth, profitable large caps are already priced to perfection. The combination is what generates the premium. Small companies trading at low prices relative to their fundamentals with demonstrated earning power. As of mid-2026, the fund's price-to-earnings ratio sits at approximately 13.19. For reference, the S&P 500 is currently trading at a forward PE of around 21 to 22. AVUV is holding profitable businesses at roughly half the valuation multiple of the broad market index. That is the house edge. It is not a prediction about the future. It is a structural tilt toward a premium that has existed in return data for 100 years. Here's the part where the honest caveat has to live, because I refuse to pretend it doesn't exist. Value investing had a decade that tested everyone who believed in it. From 2010 through 2020, growth stocks, especially large cap technology, produced returns that made small cap value look mediocre. Apple, Amazon, Microsoft, Alphabet. These companies were not just good businesses. They were transforming the global economy in ways that justified extraordinary valuations. Small cap value investors underperformed the S&P 500 by more than 4 percentage points annually during parts of that stretch. If you had held AVUV strategy through all of 2016 to 2024, your patience would have been tested hard. But which asset class was behaving abnormally? The S&P 500 returned more than 15% annually over the decade before 2025, nearly 50% above its long-run historical average of 10.4%. The Magnificent Seven stocks alone reached a price-to-sales multiple above 8 times by early 2025, surpassing the dot-com era peak. Small caps, meanwhile, returned close to their own historical average, during the same period about 11%, in line with their long-run norm going back to 1927. You think the problem was that small cap value underperformed. But actually the problem was that large cap technology performed so far above its own historical average that it made everything else look wrong by comparison. That is a very different situation. Here is where I need you to stay with me, because the numbers from 2026 are starting to tell a new story. This is where it gets really interesting. As of March 2026, small cap stocks account for approximately 4% of overall US market capitalization, according to a Fidelity analysis. Their long-term historical average is about 9%. That is a compression of more than half in terms of market weight, driven entirely by the concentration of value in a narrow set of mega-cap technology names. The current valuation spread between large cap growth and small cap value has reached levels not seen in more than 2 decades. Analysts at Janus Henderson described it as one of the biggest variations between small caps and large caps on a valuation basis going back 50 years. When we look at the forward price to earnings ratio of large caps versus small caps, focusing only on profitable companies, small caps are trading at approximately a 20% discount to parity. That is not normal. Small caps historically traded at a slight premium to large caps because investors were willing to pay for the higher growth potential. The current discount is a historical anomaly. The last time this happened was March 2000, And from 2000 through 2007, while the S&P 500 returned 1.7% annually, the FAMA French Small Value Research portfolio returned 16.2% annually. That is a gap of 14.5 percentage points per year for 7 consecutive years, not a single year. 7 years in a row as the magnificent companies of the 90s reverted and the boring, undervalued, profitable small businesses quietly compounded. Morningstar described this period as a cautionary tale for those declaring the death of value. Year to date, through June of 2026, AVUV has returned approximately 18%. Small cap value has beaten large cap growth by roughly 9 percentage points in the same period as the Magnificent Seven narrative has started to crack under the weight of its own valuation expectations. This is not a prediction. This is data from the last 12 months. The rotation is already underway. Now you're asking yourself, is this the beginning of a new cycle? Or is it a short-term blip? I don't know. I don't pretend to know. But here's what the data does tell me. You have an ETF charging 25 basis points, built on Nobel Prize-winning research, managed by the people who built the most respected factor investing firm in history, currently holding approximately 800 profitable small cap companies at a price to earnings ratio of 13 versus the broad market's 21, in an environment where the valuation discount to large caps is at a 50-year extreme. Morningstar's own analyst published a rating on AVUV in April 2026, describing its approach as one that diversifies well and balances its exposure to the quality and value risk factors. I'm not here to tell you to go all in on anything. I'm here to show you the data and let you make a rational decision. But now you're wondering what this actually looks like in a real portfolio with real dollars. Here's where I need to stop and give you a concrete scenario, because this is where the math stops being abstract. Take a 42-year-old investor, call him Marcus. Marcus has been doing the right thing for 15 years, maxing his 401k, keeping his portfolio diversified, paying a financial advisor 1% annually. He has a portfolio worth $300,000. His advisor has him in a mix of target date funds and a balance fund that charges an internal expense ratio of about 70 basis points on top of the advisory fee. So Marcus is effectively paying 1.7% annually in combined fees for a portfolio that, because of the target date fund's bond allocation, realistically expects a 6% gross return. Run that forward 23 years to retirement at 65. Marcus ends up with approximately $1.3 million. Not bad. Now imagine Marcus keeps his exact same 401k contribution discipline, fires the advisory relationship, and builds a simple 3-fund portfolio with a 25% tilt toward AVUV. His total expense ratio drops to approximately 12 basis points. Using the same 6% gross return expectation on the overall portfolio conservatively, assuming AVUV adds no premium at all over the broad market, Marcus ends up with approximately $2.1 million at 65, purely from the fee savings compounding in his favor over 23 years. That $800,000 difference is not alpha. That is money that was being consumed by fee drag and never getting the chance to grow. Now add the historically observed small cap value premium of 2 to 4% annually, which you may or may not believe will persist, and the gap widens further. The house edge over decades does not feel dramatic. It feels like nothing is happening. Then you look at the scoreboard after 30 years and realize the boring math beat the exciting story every time. Knowing this data exists and building a systematic framework around it are two completely different things. The math in that case study is real, but most people will read it, nod, and continue doing what they're doing because they don't have a structured plan that converts this kind of insight into a specific dollar decision. The Exit Code is a digital book I built to address exactly that gap. It is 8 chapters of pure retirement research. No filler, no motivation speak, built around 50 years of actual retirement outcome data. In this video, I've been talking about fee drag and portfolio positioning. 2 things in the Exit Code connect directly. The first is what I call the 4% trap, the popular withdrawal rate most people rely on. and why a dynamic withdrawal method built from actual historical data sequences performs materially better over a 30-year retirement. The second is the lazy portfolio, a historically tested allocation approach that has outperformed active traders over 30-year windows in the underlying data, and which incorporates exactly the kind of factor tilts we've been discussing today. The mathematical framework in the book turns, I should probably optimize my allocation into a specific date and a specific number. You can get it through the link in the description. For less than dinner, out for two, and every year you delay, building the framework is a year the compounding math runs against you, not for you. Let me now give you the final piece, the one that most people miss even after they've decided they like the idea of AVUV. You think the risk is that small cap value underperforms again, but actually the risk is that you buy the wrong small cap fund and don't get the premium at all. This is the reversal that matters. The Russell 2000 Index, the most widely tracked small cap benchmark, contains approximately 2,000 companies. About 1/3 of them, per data from Janus Henderson, are unprofitable. They have negative earnings. They are small companies, not because they are undervalued gems, but because the market correctly assigned them a low price relative to a mediocre or deteriorating business. Buying the Russell 2000 is buying the premium mix with a large dose of companies that don't deserve to be in your portfolio. A generic small cap ETF tracking the Russell 2000 gives you size exposure. It does not give you the premium cleanly. AVUV is not tracking the Russell 2000. It is an actively managed ETF, a distinction that matters with a daily overlay that screens for both low valuations and high profitability simultaneously. The Avantis team uses current market prices and company financials to continuously identify differences in expected returns among securities and overweight those with the highest expected return characteristics. The portfolio holds approximately 800 names, with no single position representing more than about 1% of assets. Top holdings as of mid-2026 include companies like Viasat, Matson, Lear Corporation, SM Energy, and Avnet Profitable Industrials, energy companies, logistics businesses, and consumer names that you will not find in any growth index because they are not exciting, they are boring, they are cheap relative to their earnings, and they are profitable. From 2020 to April of 2024, AVUV gained 73.9%. The DFA Small Cap Value Mutual Fund, the thing behind the velvet rope, for 40 years, gained 60.4% over the same period, according to Morningstar data. AVUV, the democratized version built by the same people, did it better, for less money, with no advisor gatekeeper required. There is a story that financial history keeps telling in different costumes. It told it with index funds in the 1970s, when Vanguard launched the first retail S&P 500 index fund, and the industry called it un-American. It told it with exchange-traded funds in the 90s. And it is telling it again now with factor ETFs like AVUV, which packages 4 decades of Nobel Prize-winning research into something you can buy at any price point on any major brokerage platform on any Tuesday afternoon. Eduardo Repetto walked out of Dimensional Fund Advisors and took the machine with him. He made it cheaper, he made it accessible, he removed the gatekeeper. The 40-year velvet rope story ends not with a dramatic confrontation, but with a quiet listing on the New York Stock Exchange in September of 2019, at a ticker that most people still haven't heard of. The DFA funds that AVUV effectively democratized are still excellent, but they still require advisors in most cases. AVUV does not. That is the whole story. Now, you're asking yourself, okay, if this is so compelling, why isn't everyone talking about it? Part of the answer is the incentive problem I explained earlier. But there's another part. Value investors endured a brutal decade of underperformance from 2010 through 2020, and behavioral memory is long. The investors who stuck it out were rewarded. The ones who abandoned the strategy and moved to growth ETFs in 2018 or 2019, right before the pandemic crash, and the subsequent rotation got the worst of both worlds. Behavioral patience is the actual scarcest resource in investing, which is why the house edge metaphor matters. The house does not leave the table during losing streaks. The house stays because it knows the math. Let me be honest about what I own and don't own, since we're here. I have a meaningful allocation to AVUV in my personal portfolio. I have had skin in this game for years. I'm not describing something I studied from a distance. I've sat through the periods where VOO or SPY were outperforming and thought about rebalancing toward whatever was working. I didn't. The boring discipline of staying tilted toward the academically grounded premium is not glamorous. Nobody makes memes about it. There is no community of AVUV believers posting portfolio screenshots on Reddit at midnight. It is not that kind of investment. Lazy investing built more fortune than crypto memes. 3 practical takeaways from this video, and I want them to be specific to AVUV, not generic investing advice you've heard 100 times. First, if you currently have a financial advisor managing your money in a standard diversified portfolio, pull up your holdings and look for the expense ratios of every fund in the portfolio. Then add the advisory fee on top. If the total is above 1%, run the compounding math yourself on a fee calculator. The number you see at the end of a 25 or 30-year horizon is not the fee line. It is the gap between what you have and what you would have had. The gap is almost always larger than the investor expects, and seeing it changes behavior. Second, AVUV is not a full portfolio. It is a tilt. The academically coherent approach is to hold broad market exposure as your foundation and tilt some portion, commonly between 15 and 30% of equities, depending on your risk tolerance and time horizon towards small cap value. A 3-fund structure with a deliberate AVUV allocation has historically improved both returns and diversification relative to a pure S&P 500 portfolio. You are not replacing the market. You are adding the house edge to the side of the market that the data supports most consistently. Third, the current valuation environment matters for entry point psychology, not for the long-term thesis. You do not need to time a perfect entry into AVUV. The 40-year historical evidence does not care whether you buy today or in 6 months. But understanding that small caps currently trade at a roughly 20% discount to parity, with large caps on forward earnings at levels Janice Henderson called a 50-year extreme, should reduce the psychological friction of initiating or adding to a position. You are not chasing performance. You are buying something the market has been ignoring for a decade at prices the market has rarely offered. That is what the house edge looks like when it's sitting on the table. The velvet rope is gone. Eduardo Repetto built the machine in public. It charges 25 basis points. It requires no advisor. It is available on every brokerage platform in the country. The information is now yours. What you do with it is up to you. Lazy investing built more fortune than crypto memes. And the financial industry will keep not mentioning AVUV by name for exactly as long as the fee structure makes it rational to do.